But our next presenter is Nick Balkin. He's one of the PMs at Foord Asset Managers, and he's one of the lead managers of our stable fund, which we're really proud of. It has delivered inflation plus returns to its mandates with a very consistent return profile, and has managed to protect investors' capital over rolling one-year cycles right through its inception, and that's really a key focus of this fund. And certainly this has been achieved by Foord's and Nick and his team's ability to diversify across a range of asset classes and to enter into longer bonds when they're offering value, or offshore when they're seeing value there, or in other equity markets. So we look forward to chatting to Nick now about how he's seeing this diversification as being a key component of their investment philosophy at Foord. So over to you, Nick. Look forward to hearing what you have to say.
Cool, thanks, Doug. Yes, so apologies, I heard there were some technical difficulties, so hopefully we have a bit more plain sailing. And everyone knows I have a habit of talking pretty quickly, so you never know, I might be able to catch up also. Yeah, it's just really exciting to be back presenting. I really do enjoy sharing our views of where the world is. And maybe it's a bit of vaccine bias, but I'm expecting in the next 2 or 3 quarters to be presenting in person to you guys. So yeah, positivity around that, and just looking forward to kind of shaking hands and meeting you guys in person. I think let's start with what the focus of the fund is, right? The focus of the stable fund is 2 things: to manage the downside risk, but also to beat inflation over time. So we do that in a few different ways. The standard way is stock selection, sector allocation, asset allocation, but the real magic between all of them is this word diversification, and it's understanding the correlation between all the different asset classes. That's really where the magic lies, and that's what the title of the chart of the presentation is today. So let's dig a little bit deeper into diversification. Most investment or the investment industry has a habit of attracting pretty confident people to the industry, which means they kind of believe that their view is the only view. And that leads to people maximizing their own return, or maximizing their return and worrying less about the downside. And that works in good times, obviously, and it's a great thing to see. But, when things turn down, this lack of understanding of correlation between asset classes is exactly what the downfall is. When things start going down and your assets are correlated, there's nothing to protect you. So when you think about diversification, that's the way to create stability in the fund. Our brain can't comprehend the different outcomes that we have in the world. And we just have to look at COVID as an example, that it was in no one's thought process before it happened. So it's about planning for the uncertain times, understanding that if you have an uncorrelated asset like a gold that sits in a portfolio, yes, it will be a headwind sometimes, but very much it will also be a support when you need it, and is going to perform in an uncorrelated way to the rest of your portfolio. So I think that's the important piece of diversification. It adds stability to our portfolios, and I think that's a very important starting point for the presentation. I think inflation, and William wrote a great article, I don't know if it's been published yet, on the secret killer, which is inflation. Inflation doesn't seem that, scary when you hear 2% inflation. But he wrote a great article showing that if you have a currency that has 2% inflation against another currency that has no inflation, you will lose half your purchasing power over 35 years. And therefore, the main job, as I said at the start, of the way we think about managing money, and especially on the stable fund, is to increase the certainty of achieving an inflation-beating return in our portfolios. And as you can see from the table, I really don't love going through these because these are all known knowns. But I think it is good to harp on some of the performance. I think long-term performance over 3 and 10 years remains exceptional. to achieve CPI or inflation plus 4% over a consistent long-term period is just a really positive thing that we're proud of, especially since it's only maximum 40% in equities. In fact, if we look at the year that's gone by, we continue to be very proud about that also. Although it's 6.7% is not inflation plus 4, it's still above inflation. It's a very strong number in the context of how we manage money. And I spoke about the diversification, which I'll go into a bit later. So there were some headwinds that, impacted that number over 1 year. But whatever they were actual tailwinds that provided that 8% compound return over the 3-year period. This is the part I don't love. It's always good to update people of where the returns came from. It's not how we manage money. It's not how we think about money. We think about money and managing money in a much longer term basis. We're trying to look 3-5 years out, trying to see where the world is going and manage portfolios. But, it is important, I guess, to understand what happened over the quarter, 6 months and 1 year. If you look at the average weight at the bottom, I think that's quite an illustrative place to start. You can see where our biggest weights are. We've spoken quite a lot about interest-bearing bonds, interest-bearing assets, and I'll go into it in a bit more detail. But just noting that these are contributions. So a lot of the time, this is how we think about our performance. And it relates to the diversification benefit that I spoke about. That sometimes we'll have a big weighting in one segment of the market, maybe it's SA retailers, and therefore we won't have the same amount in SA bonds as a result and trying to manage the concentration risks. And therefore, attributions sometimes aren't the best way to analyze our performance. So if you look at the contributions, the heavy lifting, given the weighting, was definitely over this period was the domestic equities. At 12%, it generated 1.3% return over the 6 months. And interest-bearing backed by the 186, which you've spoken a lot about, was the other heavy lifting in the portfolio. The foreign assets, although it underperformed domestic equities in rand, still did phenomenally well in dollars, and obviously the rand was a big headwind. As I spoke about, the gold ETF that we have at 5% is an important diversifier, and it did exactly what we expected when things were good. And what we're expecting is for that to do the opposite when it's most needed. So it's absolutely performing to plan in our minds. I would say this is more of a tick the box kind of summary of what I just spoke about. I don't really want to, go through it in a whole bunch of detail. Suffice to say, it is generally what happens to us is a few ticks and a few crosses. That's that diversified nature of how we manage money. I did put a cross on the full foreign equities. It's probably unfair given it's a timing issue. As I said, the dollar return was phenomenally strong and we're very proud of it, but it, translated into rands technically on an attribution basis detracted. So, I think I've spoken about that. There's probably no need to harp on the summary. I guess the world is a crazy place right now, and for numerous reasons. The first one is obviously this chart is a hell of an interesting chart. It's a 10-year moving average, so it takes out any spikes, the US Federal Reserve over time against the US inflation. As you can see from the gray line, we had 10% inflation over 30 years ago. Now, that's not dinosaur times. That's in all of our lives. We were probably all born when the US saw interest rates of 10%. Importantly, you can see the big divide between the green arrow showing the big divide between the gray and the red line, which is effectively the yield that you would get by placing your money in money market above the inflation rate. So you could sit quite safely and earn a real yield by just sitting in the money market. As you can see, that's come down. The Fed's fought inflation quite hard, and they've been able to reduce that real yield as time has gone by. And the green arrow has got smaller till we got the crossover point, as you can see on the chart. That's what we call financial repression. Financial repression is spoken about a lot in financial markets. It's spoken a lot about in news articles. I don't think people really explain things simply. Financial repression just means effectively that the government, and I use inverted commas, The government is stealing money from the savers, and they have to, right? They're trying to incentivize animal spirits. They're trying to incentivize savers to stop saving and to spend their money, and it has obvious implications. The implications are that it forces people into markets, it forces people to buy assets, and it creates, I guess, inflation. But what it also does is it deprives the saver of other opportunities to generate a real yield, especially when you think about the benchmark being 4% above inflation in the stable fund. So it's kind of creating a bit of an issue for a saver, and it's making the saver make equities the only game in town. So what do we do about that? Do we just go and put all of our money in equities? Is that the best thing to do? Well, for an ultra long-term saver, maybe a very young person that's got a very long time horizon, you could actually justify holding a high weighting in equities right now. Equities tend to do very well over the long term, even from these kind of starting points, but the volatility will be immense. And when you think about a stable fund and the stable returns, if you're investing in the index, so if you look at the ranges, what I've done there, and we put this chart a few times, showing the kind of long-term PE ranges of the S&P. And there's the 14 at the bottom in gray, and the red is 19 times. And you can see how much higher the PE is in than the ranges. The good news is, at Foord, we don't invest in indexes. We have the ability to go and invest in stocks. We have spoken a lot about the opportunities we've seen on the global fund, but we've spoken about it, but it's worth reiterating. We have companies that are dealing from the economic cycle. We have biotech companies that, whether the good times or bad times, if the company does well and it generates a drug that is saleable, it will do well. We've spoken about other opportunities that we always talk about, selling shovels to the growth industries. That's the safest way to buy into the future without taking the risk. So effectively, another company we've spoken about is a laser cutter that generates all its profits from automation in the manufacturing industry. That will do well in good and bad times, and it will do well if the high technology companies fail or not, because they'll just go to who the winners are. So I think the important thing there is, obviously, equities are high in value, and you have to be much more careful, and you have to buy equities that have pricing power. Pricing power gives you an extra flexibility to deal with the inflation should it surprise on the upside. It allows any company to pass it through, creating stability of earnings and stability of price, and therefore stability of pass-through into the portfolio. So that's what we're looking for, and we absolutely need to prepare for higher inflation. This is the chart of US inflation. Seldom on this kind of chart do you see inflation of 5% in the US. It's a phenomenally high number. Yes, there is a lot of base effect. There is a lot of conjecture, and the Fed have really taken the stance that it is transitory. Transitory means that there won't be a permanent change to inflation expectation. People will continue to expect 2 to 3 or 2% inflation in the US, and therefore the 5% will come down as, I guess, the base effect normalizes. But this is the stance that could quite possibly let the genie out of the box in our minds. The Fed have changed their mandate to a more rolling thought process of where inflation is, and they'll accept higher inflation for longer. And that means that in our planning and our tail risk planning, we absolutely need to think about higher inflation for longer. Following on from that financial repression, that's one of the things that the tools of the armory in the Fed is to kind of inflate their way out of the troubles. So it's absolutely not a zero probability event that we have higher inflation, and it needs to be built into our thought process. Talking about South Africa, financial repression, we avoided it for a long time. You can see on this chart the grey bar being the interest rates and the red bar being our inflation. Until recently, we had an interest rate that was higher than inflation, which meant we were able to get a real yield by sitting in cash. More recently, we've seen our inflation pick up and our interest rates come down, and it's making it a lot harder to achieve our mandate by sitting purely in cash. But we've communicated that a while back. It's important to know how to deal with that. This is what I speak about, is diversification, also understanding what can go wrong, because it's very easy to just say, and this chart is quite an interesting chart, the red line being the 10-year bond in South Africa, and you can see all the other global bonds. It's appealing in nominal terms, and it's appealing in inflation terms also, or real terms, meaning that 9.3%, or it's slightly higher than that right now. Why don't we just buy 100% of the portfolio and go to the beach and just say we've achieved our mandate? The thing is, it comes back down to this diversification, understanding that you could be wrong, understanding that the tail risks are important to quantify and value. And actually, we don't have the majority of bond holding in this higher yielding 10-year bond. We've spoken about the certainty of return that's way more important to us than, I guess, maximizing return. So although these high yields are out there, we continue to be more cautious, to choose certainty and go for a more mid-duration bond that won't yield that as the 9.4% that you see on the screen, but closer to 7.5% that you can get for the 186, that's around 5 years. And importantly, the inflation will be under control and can be absorbed by that interest rate over the short term, and we get our capital back in year 5, which allows us to price the bond a lot better. We've spoken about this a few times, but the SA government debt, however you look at it, is on potentially an unsustainable trajectory as we see it. We have been bailed out to a certain extent by the resource royalties that we're getting on the super prices that we've got, but unfortunately the chickens do come home over time, and there will be two effects of that. There'll be dividends flowing out from the resource companies as they pay out these super profits back to the foreign holders, and also I forget the other. Once the commodity prices unwind. So importantly, the other thing I forgot to mention is also the tax base is busy being hollowed out right now, and we need to be cautious what happens once things normalize in commodity prices. Moving to the Rand, I think it's a very similar picture. Current account usually shows a strength and is a good indication of a fair value of a currency. What we've seen more recently is exactly the same thing. It's a super profit that resulted in a positive current account as we continue to sell high-priced commodities into the market. We even have some port troubles on the other side to import, so we're having to produce a lot more product at home. And therefore, this we believe to be transitory also. I spoke about the dividends that will flow out also. So in our planning, we continue to believe that the Rand is artificially being driven by forces that aren't sustainable, and we continue to believe that the best plan is to plan for a Rand weakness over time. Nothing we haven't said before. Equities that have pricing power is the best way to deal with the uncertainty. We need to make sure that we avoid the low returning domestic bonds. Our SA bonds are interesting, but we will not have too much. We'll maintain balance. And gold, although a headwind, will be a diversifier when we really need it most. And that's how stability is generated. What have we done in the portfolio over the last year? I think with the financial repression, you can see the slightly darker yellow bar, which is the SA money market, which has moved from 12.9 down to 8.9%, as we've continued to move some of the money out of the money market into government bonds, as well as some smaller discrete opportunities in the SA side of things. We've spoken about opportunities before, but if you think about the hospitals in South Africa, they're a great way to play defensive growth that will continue in good and bad times, and they're actually trading very well in the third wave, based on what we've heard. Putting it all together, I don't know, I haven't kept a very good track of the time, so I'm sure I'm running out of time. If we just look at the top holdings, the highest weighting is the 186 that I spoke about. It's 25% of the portfolio. Then comes the global funds that we have as our building blocks. It's important to understand that having a bigger weight in a shorter duration bond is actually lower risk than having bonds in the higher weighting. It's not a higher risk just because it's a bigger weighting. Because of its duration, because of its high coupon, it is actually a much safer place to be in the SA bond market. And you can see the balance with some financials in SA and resource in SA, which is largely consistent with what we've said before. So in conclusion, I also don't want to go too much into this. It's just a kind of thought process of how we think about the world we might go in. We still don't know which world we're going in. There's demographic forces that are pushing down on inflation. There's financial repression from the Fed and others that are pushing up inflation. And we need to plan for both scenarios and make sure the portfolio is resilient to achieve outcome and inflation beating returns in both scenarios. So I think it's important. It's a life lesson. Don't be greedy. Understand that we don't have a 100% clear picture of where the world is. We need to plan and diversify across different scenarios to make sure that we continue to achieve the financial goals of everyone in most scenarios. So I hope that was a quick summary of where we are, how we positioned. I'm not sure if I caught up time or didn't, but yeah, I can hand over back to Doug and let's see if we got time for questions.
Thanks, Nick, and appreciate your insights there. I think certainly the global financial repression is a theme that has been talked about throughout this morning's presentations, and I guess it is a concerning theme, but at least in South Africa we do have these high yields, but they do come with risks, and I guess that's why a lot of our managers in the Nedgroup Investments Stable are certainly sitting more towards the mid of the midterm rates, or midterm bonds, and towards the lower end. So that's very interesting. Nick, that is all we have time for today. We are running slightly over schedule, and we are obviously concerned and conscious of people's time on the call. If you would like to find out more information about how the stable fund is run, and certainly some more insights into how Nick and his team are thinking about the fund, we do produce a global commentary, or a quarterly commentary, which you can access via the website, and that'll be posted to our Nedgroup Investments website later this quarter.